Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I have with me Brad Newcombe, Head of Research at Fixed Income Solutions, and we're going to be discussing the new proposed changes to capital notes, also known as additional Tier 1 securities and hybrids. I first met Brad many years ago when we worked together, and he has a long and deep understanding of the hybrid market, and we're privileged to have him on as a guest. Welcome, Brad.
Oh, thanks, Liz. Great to be here.
I'm really excited. It's been a while since we've chatted and talking about hybrids, one of your favourite topics. So perhaps we could just start with, if you could just give us an outline of some of the changes that have happened over the years to the securities.
Yeah, it's been a really evolving market. I mean, when I first became involved, or prior to me formally becoming involved in it, we started off with what was known as pure income securities. That's had some issued by the National Bank and Macquarie. They weren't technically Tier 1s, but they were what was known as upper Tier 2s, and they were probably the first ones that came out of the market. And then it evolved to a new type of hybrid or additional Tier 1, known as the step-up preference shares, where the securities would be outstanding for a number of years, and if the banks didn't redeem them at a set point in time, and they'd step up in their coupon rate. But as they became more involved and past the GFC, further changes were made, and we've now had a pretty stable system for about 10 years, and known as the mandatory converting preference share type structure. APRA's made a few tweaks to it over time, but that's been really the standout or the structure that we've had for quite some time now in the AT1 space.
And they're really they're there to support the capital requirements, aren't they? They're regulatory requirement for banks and financial institutions. And so do you consider that their current form, like it's appropriate for the job they are intended to perform?
Yeah, I actually think they have been working well, although they've been relatively largely untested. Australian banks continue to be incredibly well supported by equity investors. So what we've seen historically is that at the first hint that there may be some potential storms brewing in the banking sector, the reaction for the banks has just been to go out and raise equity, which helps prop up the additional Tier 1 securities and the Tier 2s that sit above them in the capital structure. So that means we haven't really seen any material pressure from a pure loss perspective, even in the GFC or the pandemic. When I sort of refer to as material pressure, I mean in the context of investors actually receiving a permanent write-down on their capital investment. We've seen in periods of significant distress, there's been some large mark-to-market movements in the price of the securities, while the instabilities occurred, but we haven't really seen any losses on any of these hybrids or AT1s since they've been issued.
It's interesting because, when some of the American banks failed late last year, really, APRA, I think, got nervous that retail investors might lose money if the hybrids needed to be bailed in. Do you think that's part of the reason that they want to, or is that the main reason they've wanted to review the sector?
Yeah, I think you're spot on there. I suspect APRA has essentially been in having talks with ASIC, because ASIC has always had it's been a bit of a bugbear for ASIC about them arguing that retail investors don't understand the risks involved with hybrid securities. So, which is always a bit bemusing. So you can invest in as many bank securities, which will lower down the capital structure as you want. Pure equity, it's fine. You can go and risk your entire life savings on a junior gold mining exploration company, but you can't invest in hybrids, or they don't like you invest in hybrids for some reason. And I guess a lot of that comes back to what happened with Credit Suisse, with the write-downs that occurred there. They proved that, or their argument would be that what can occur is, and people weren't expecting those level of write-downs. There are quite a few differences from that. The language used in the Credit Suisse documents was a lot more ambiguous and not as clear-cut as what you would see as those used in the Australian hybrid market. So that's one thing I would say there. But it's certainly looking like APRA is really looking at this from a prudential perspective and just sort of saying, we don't want retail investors investing in this product. And then they point to the fact also that in most international markets, this is purely an institutional product. You don't see that. Australia is really the only market in the world where retail investors can access the additional tier one security. So I can sort of see where their points are along the lines that it is, it's an outlet for retail investors to be involved in this market. But by the same token, I think it's underestimating the knowledge base of retail investors to say they don't understand the risks involved.
Look, from my perspective, I always think, if people don't understand, educate them, give them a test, put the warning signs on the packet, you can lose money, and let people invest if they want to. It should be, I think, a more free system. But, I do understand concerns, and I certainly have met investors that do not understand the complexity of hybrids and what they're investing in. Just going back to an interesting point I find is that, and I should have been a bit clearer, with the American banks, they failed so quickly because people were moving funds electronically. And the way hybrids are currently designed is that they bail in before subordinated debt bails in. And there's meant to be a bit of a gap there theoretically, although, as you say, it's never been tested. Do you think that's one of the concerns as well now that the regulators are just thinking, well, there's probably not going to be any difference in those levels if the system is tested?
Yeah, I think also there's a few differences with the American banks when they collapsed. The biggest one is the regulatory capital treatment, that they have very large bond portfolios, and which I didn't realise this until I looked at the post-collapse. They weren't required to mark those bond portfolios mark to market. So they were sitting on large, massive losses on these portfolios that weren't flowing through to their capital ratios. Now, that would never be allowed to occur in, I don't think, any other prudential jurisdiction around the world. And so when that happened, their capital ratios were realistically completely blown already. And so then you got a liquidity crisis, which is typically the cause of the collapse of banks, not capital, but it was the combination for these American banks. So, and it also goes back to the fact that in America you have a lot more smaller institutions in the banking sector, and different, even state regulators as opposed to national rated. Whereas Australia tends to be very well regulated by the one regulator, and it's dominated by a few large banks and second tier banks. And I guess probably more to the point, what you're getting at is that what we're seeing from APRA is a real drive to continue to force consolidation in that market, especially with some of the smaller credit unions and building societies, and really increase scale so you don't have these smaller institutions that are probably more prone to collapse.
They're excellent points. Thank you for those. So if the proposal proceeds, and perhaps do you want to just outline quickly what the proposal is?
What we're hearing is that the proposal will proceed. It's a long phase in time. It's around 2030 from memory. Before it will have to be enacted properly, which will allow all the existing hybrids to basically roll off in that time to solve that problem. The big point of contention, I think, is that the banks aren't required to put in much additional capital at all. Like the larger banks only have to increase their core equity tier one ratios by a quarter of a percentage point, 25 basis points. And the smaller banks don't have to increase at all. So they're basically expecting that whole gap that the tier ones are being provided to be filled with tier two securities, which is, certainly interesting. And it's technically making the banks riskier propositions in that they can replace it with a cheaper form of capital, being the tier twos, rather than having that tier one there. And I think it's probably why APRA's going down this path, is potentially to appease the banks in that they'll be, if they had to replace that whole amount with ordinary equity, then they would have kicked up a massive stink about this proposal, whereas they're far more likely to go along with it if they can replace it with cheaper capital.
I wonder what happens, or what additional changes there'll be needed to be made to subordinated debt. Will there be different levels of bail-inable capital there, or will it stay as is? And will there be any level of like non-viability or capital trigger type thing? I don't know. Do you have any thoughts on that?
It's a really good point. I don't want to preempt too much what APRA will do, but that's certainly a possibility that they will look to make changes, and certainly around the bail-in levels, to make them provide a little extra layer of protection. It might not be at the point of non-viability, or when they might look at changing those sort of triggers, which is really a tier one sort of concept. They might even look to change things like typically your tier two securities are what we call a 10-year non-call 5, and then they've got a 10-year legal maturity but can be called after 5 years. They might look to extend the legal maturity a lot longer to make them more like perpetual securities, like tier ones, or they may even introduce a tier two to the market that has a call date up to 5 years but is perpetual. So I don't want to limit what they potentially do, but there's certainly a huge range of options on the table as this sort of progresses and the consultation period goes on.
Which makes it really interesting. And do you think, also just talking about subordinated debt, do you think they'll make some subordinated bonds more readily available, like through the ASX?
That's a really good point too. And we've been thinking about that. We're actually thinking, will the banks just try and, move their tier ones and get retail investors to invest in tier twos? And that raises the point. I wonder, will APRA and ASIC be happy with that idea? Will they think that if they weren't comfortable that retail investors had a proper understanding of tier ones, will they think that retail investors have an understanding of tier twos, which are a simpler product, but certainly have some complications around them? So that's going to be a really interesting point if that just becomes, a straight switch from tier ones, retail investors from tier ones to tier twos, or if they really encourage retail investors to stay away from that market and try to move it back to a full institutional market.
We'll have to wait and see. But obviously there's got to be some other changes to subordinated debt, like credit ratings might change, do you think?
It's definitely a possibility. Again, don't want to preempt what the credit rating agencies are going to do. I don't think there'll be any near-term changes. I think this will, be as the tier ones continue to phase out, the tier twos become an increasingly high proportion of the bank's capital structure, and even the core equity tier one, or your just ordinary equity, basically remains the same. I think that's when the changes will start to come in. And it'll be interesting because right now the rating agencies have quite a, standard process on how to rate tier ones and tier twos. But that's in a world where there are tier ones and tier twos in every other market. And when you move into a market where you're only going to have tier twos and no tier ones, so they then have to adjust their credit ratings to reflect what should be a higher risk for the tier twos. So that's, again, going to be a really interesting point to watch. And I certainly think it's a possibility down the track.
And of course, if the credit ratings change, the yields need to change. And it was quite interesting looking at the market when the proposal was announced. Do you want to just talk through what you saw in terms of what happened with yields? And
yeah, we think, the tier one's slightly tightened a bit. I mean, because they're no longer perpetual. They're going to get called now because APRA is saying you call them. No, we don't think that was a major risk in the first point. I mean, the Australian banks have called them the first opportunity, just about every instance that I can think of. So it wasn't a material risk, but there's a slight tightening. But the other thing is the scarcity factor now is I think the market realises there's no more of these securities being issued. So if you want to buy them, here's your last chance to grab them. We didn't really see any movements as far as we could see in the price of tier two securities, and we don't think that'll happen at any time soon. Although, once again, as tier twos become a much higher proportion of the capital structure and technically become riskier, then we think they will start to move. We don't ever think they'll get to the level of tier one securities, but there is certainly scope for a little bit of spread widening to occur in a few years' time.
It seems like in the current market, at least, there's such huge demand for subordinated bonds at the moment that it could easily be absorbed, those small percentage increases.
Yeah, and that's a good point too. I mean, it's still going to be a lot of money coming into that market. So larger scale market, more supply required might need to increase the price to meet the demand as well. That's another factor there. So, but I think it'll get absorbed, especially as you were discussing earlier. If the retail investors are allowed to invest in it, then I think it will get absorbed pretty quickly.
And just thinking about international markets, do you think international investors will readily accept the new structure for Australian financial institutions? And, to my mind, it's going to put us out of sync with the rest of the, developed world. So do you think there's a possibility other central banks might follow our revised model, or it's just going to be like a one-off because they want to eliminate those retail investors from the market?
Yeah, I think it's possible, but unlikely. I think the root cause of this seems to be APRA and, having in conjunction potentially with ASIC, trying to get retail investors out of this market. And that's not an issue at all for any other market in the world where it's purely an institutional product. So I think most other regulators will stick with the tier 1, tier 2 model. Maybe they'll look at it as a sort of, case in point to sort of see if it's worthwhile doing, but I wouldn't think there'll be any changes. But it may occur down the track if the other regulators have looked at it and going, yeah, why do we need two types of bail-in capital? So it'd be interesting one to watch as well.
So the proposed phase-out term is long, as you said, 2030, so another 6 years. What do you think investors are going to do with their maturing capital? And have you got any suggestions about where they might think about reinvesting? Obviously, they want the high yield. They're looking for high yield. So,
yeah, I mean, one option is they might just switch straight to ordinary equities and switch their hybrids into ordinary bank shares. That's one option that we might look at. There's also another option is that while it's dominated by retail investors, a lot of these retail investors will also qualify for the sophisticated investor test. And it'll be interesting to sort of see if they sophisticated investors can participate in the institutional market overseas, and they might say, well, we're just going to go and invest in additional tier 1 securities of international banks in US dollars and Great Britain pounds and the like, some euros, and sort of get those yields, which have actually traditionally offered high yields in the first place as well. So there may be an element of that. There's an argument also that it might, especially if the banks can issue tier 2s as listed securities. I'm sure there'll be a flood of money going into that occurs. And I guess the hope for us is that it will expand just the general fixed income market in Australia, and any sophisticated type investors will be able to just buy in over-the-counter products in the corporate fixed income market in Australia. And, the ultimate hope is that we expand the retail fixed income market and have more ASX-listed securities. And so people can move away from hybrids into just traditional senior notes from strong corporates that are listed on the ASX. That'd be a fantastic solution as well.
I couldn't agree with you more. We would be hoping that might be the case finally. Keep watching this space.
Been a long time coming.
It's been a long time coming. Do you have any other thoughts or observations about the proposed model or even the Australian fixed income market?
Yeah, well, not so much on the model, but in relation to the fixed income market, I mean, getting back to sort of what I was discussing before, it is a bit disappointing that hybrids are getting, phased out, so to speak. Hybrids aren't a pure fixed income market, but they do provide a lot of investors a sort of introduction to fixed income, and it is a quasi fixed income type product. And considering we've already got such a limited universe of fixed income products in Australia to start with, to sort of get rid of one of the key components of that market, it's really disappointing. So I think that's my real key observation. We're trying to really grow the fixed income market and I know this has always been one of your key points, that you compare what the fixed income market looks like compared to a lot of European countries and New Zealand and even the US. It's far more readily available to retail investors and accepted. And, this is really a retrograde step and sort of driving that one step back, unfortunately.
It definitely is. And we will continue to watch this space. And just finally wrapping up now, it's always good to hear a bit about the companies our guests work for. Can you tell us a little bit about Fixed Income Solutions and your role specifically in identifying opportunities for clients?
Yeah, so we're a pure fixed income investment house. So we look to find value anywhere across the market. I sort of mentioned before, we've recently seen a lot of value in actually an international bank, USD and Great Britain pound denominated AT1s. That trade sort of gone a bit now. It's the value that was there, 6 months ago isn't what it was, but that really was a trade that hits our key markets. Our clients are really looking for sort of 8 to 10% returns without taking too much risk. Those AT1s and for some really, high quality international banks is one area. There's a few other areas that we can find that sort of risk reward trade-off. We also look for clients to go in that higher risk space, so your low teens to mid-teens, but that tends to come with a fair bit of additional risk. And so we're really tasked, or certainly in our credit team, and as I said, what our clients want is that real 8 to 10% range, and that's a real sweet spot for our investors.
Brad, thank you so much for joining us today. It's really great to get your insights. This market has been moving since forever, really, since I've followed it. And you've certainly given us a few other things to think about. So thanks very much for joining us.
Oh, thanks, Liz. Pleasure talking to you again.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.